If we were sitting across from each other right now and you asked me what to do with your expiring life insurance, I'd give it to you straight. No sales pitch, just the math. As a licensed agent in Ontario, I am required to disclose my business relationships and how I am compensated before we do any planning. You can find my full disclosure in the link below. But for the next few minutes, we are entirely focused on objective market data. You are 58 years old, married, with 2 teenagers at home. And that 10-year, $200,000 term life policy you bought in your late 40s is about to expire. Navigating this specific transition requires looking past corporate marketing brochures. We have to use raw, unbiased data to protect your household. This chart shows exactly how your financial risks have shifted. When you were 30, you needed massive income replacement coverage to protect 3 decades of future earnings. At 58, that massive curve drops off, intersecting with a smaller, highly specific set of midterm debts. Those remaining liabilities usually boil down to 2 specific obligations: paying for your teenager's upcoming university tuition and clearing out the final years of your mortgage. There is a critical secondary goal here. You need to ensure your surviving spouse never has to liquidate their hard-earned retirement assets to pay off those remaining debts. The problem is that acquiring a new $200,000 term policy at age 58 triggers a steep age-based rate jump. You are forced to make a careful choice between Ontario's top 5 carriers: Industrial Alliance, Canada Life, Manulife, Sun Life, and Foresters Financial. At this stage, your priority is to acquire the exact bridge coverage required to match your remaining liabilities, making the sticker price secondary to the structural fit. We are going to map this out using a comparative matrix. We will evaluate the estimated monthly premiums, the core perks, and the conversion rules for a 58-year-old non-smoker across the major carriers. First, we look at Foresters Financial's YourTerm product. To access this option, you have to be willing to undergo a full paramedical exam and clear standard underwriting. Passing that exam secures the lowest baseline premium group of the top 5, roughly $75 to $85 a month for men and $54 to $64 for women. A policy with Foresters also brings fraternal member benefits, including community grants and highly valuable university scholarships for your children. The trade-off is strict. If you have emerging health issues and fail to qualify for those pristine rates, the medical exam was a wasted effort. Foresters demands a high risk in exchange for its high reward. Next is Industrial Alliance and their pick-a-term model. This product allows you to select an exact, customized timeline. If you have exactly 13 years left on your mortgage, you can buy a 13-year policy to match that exact payoff date. You pay for that customization. Their baseline premiums sit at $78 to $88 for men and $56 to $66 for women, slightly higher than Foresters. Canada Life's YourTerm product operates at a very similar baseline price point, but they structure their value around volume banding discounts and a feature that lets you reset your coverage term to term. There is a hidden structural constraint with Canada Life. They cap your ability to convert the term policy to permanent coverage at age 70, which is earlier than most competitors in this bracket. Both of these carriers charge a flexibility premium. You have to decide if customizing your exact term length is worth a higher monthly baseline cost. Manulife's family term requires a distinct behavioral input to maximize its value. You have to opt in to their Vitality Wellness program. Vitality is an active commitment. It requires you to continuously track and share your daily health habits and biometric data with the insurer. This active participation triggers continuous premium discounts based on gamified healthy behavior. This lowers their otherwise higher baseline rates, which normally sit at $82 to $92 for men and $60 to $70 for women. Sun Life's Evolve term takes a different approach. Their Coverage Evolution feature is designed to let you adjust your policy around major life events, entirely skipping the behavioral health tracking. Sun Life sets their permanent conversion cap at age 75. That gives you more late-in-life estate planning flexibility than Canada Life, though slightly less than IA or Foresters. Manulife and Sun Life are lifestyle bets. They reward clients who are willing to share daily health data or those who prioritize built-in adaptability for future life events over baseline price. This decision flowchart translates that matrix data into a practical strategy based on your specific health reality and your lifestyle. If you need a highly specific time frame, say exactly 12 or 14 years to match the tail end of your mortgage, the winner is Industrial Alliance. If you want to gamify your health tracking and you are completely comfortable sharing personal data with an insurer, the winner is Manulife. If you are in pristine health, willing to take an exam, and want college scholarship opportunities for your teenage children, the winner is Foresters. Selecting a life insurance policy at age 58 requires matching your tolerance for medical exams and data tracking with your specific debt timeline. Based on your profile, 58, married with 2 teenagers heading toward college, here is my definitive recommendation. Foresters Financial is the optimal choice, assuming you can pass standard medical underwriting today. The math heavily favors this route. The fraternal scholarship access directly subsidizes your family's largest looming liability, university tuition. That creates a secondary financial benefit the other carriers cannot match. There is a firm caveat. If you have had recent health issues or if you refuse to take a medical exam, you must abandon this strategy immediately. Pivoting means you will have to utilize guaranteed or simplified issue policies. You will pay significantly more per dollar of coverage to secure that safety net without the medical friction. Lock in the right structural bridge coverage today while your health still permits. It's the surest way to guarantee your family's financial transition is protected.